Welcome, my name is Vishal Tekchalani. In today's Meet the Manager episode, I'm speaking to Dermot Woods, Executive Director at Westoz Funds Management, and he's going to share with me some of his expert insights on investing in the commodities sector. Dermot, it's great to have you here. How are you?
Fantastic. Great to be here.
So Dermot, why don't you tell investors a bit about yourself? How did you get interested in funds management and a bit of background about Westoz?
Sure. Well, I got interested in funds management 20 plus years ago. I left Edinburgh University with a nice, shiny accountancy degree, knowing one thing: I didn't want to be an auditor. And so a voyage of discovery started, and it started in an investment accounting department. There I got to see funds in operation, and I just became fascinated. I worked some shoe leather in London, and I got to start with HSBC Asset Management, and sort of haven't looked back from there.
Excellent, and you ended up in Perth.
Yes. Now, I never thought I'd end up in Perth. You know, I wanted somewhere to live that wasn't a big crowded city. I'd lived in quite a few big crowded cities. I'd lived in London and Dublin and even Paris briefly, and I came to Australia thinking it would be Sydney.
Okay, and Westoz Investment Company, do you want to give our investors a bit of background about that?
Sure. Westoz Investment Company started in 2005, and the ethos of Westoz Investment Company is really simple. We live in Perth, we spend all our time in Perth, and we have that experience, so we should be able to outperform if we stick knitting, investing in a universe where nobody else is really concentrating.
Wow. Okay, so you live in Perth and you are at the epicenter of the commodities market, right? Pilbara, BHP, Rio, you've got all these big companies and the little ones, of course.
Yeah.
Help our investors dissect the commodities sector. How do you actually approach investing in this part of the market? Because it can be quite cyclical, right?
I mean, the first thing to say is we don't just invest in resources stocks. And the second thing on that point is we apply the same process to resources stocks that we apply to normal companies. And there we work through people, we work through capital, we work through cash flow, and we work through valuation. So maybe I'll just compare those individual sort of topics to the resources sector. So with people in resources, for example, well, you get a lot of companies with a guy may have been looking at a zinc project one year, and the next year he's looking at a lithium project or a uranium project, for example.
Right.
We're not particularly interested in that guy. We're interested in the people who live and breathe the sector that they're in.
Okay, so when it comes to people, specialty is a really important thing.
Yes.
So if they're a geologist and they specialize in, I don't know, zinc or nickel, they should be focused on that for their career in the long term. Is that the kind of way
we want
about
people who are experienced at running mines and running companies.
Okay.
And generating cash flow for shareholders. And we like those people to invest in their own cash in the business as well.
Okay, and then when it comes to the two others?
We look at capital, it's a very interesting one with mining companies. There's a couple of issues there. The first one being, make sure the capital base hasn't blown out. So you get a nice little project, which if you started with a blank sheet today, would look fairly attractive in terms of returns. But previously the management might have spent too much money on exploration that hasn't worked, or too much money on studies, and the capital may have blown out and it just may not work as a proposition.
Okay, so with capital, from an investor's perspective, help them understand, is it the debt level they should look after? Is it gearing level?
There's a few aspects there, and one thing I focus on people is what's left for the equity holder. So the examples I give there, or the extreme example I give is, you'd have a company that's hedged a lot of its production, that has offtake for life of mine, and has debt. And in that situation, I simply say to the management, what's left for me as an equity investor? Because we're going to be 3 or 4 years paying back the debt. Nobody's going to come buy your operation because you've dealt a life of mine offtake. Right. And you're hedged, so there's no upside on the commodity.
Okay, so very interesting factors to watch. And the last one?
And then we look at cash flow. Quite simply, we need to be able to ascertain cash flow, so we don't do exploration. And we've been running for 13 or 14 years, and we've stuck to our knitting on that. The small times we've gone into exploration, we haven't really enjoyed the experience. Okay. It's too risky for us. There's enough risk, as you've pointed out, in the resources world without taking on the exploration risk.
So we've talked about your overarching approach to resources. Help investors understand how you may pick some of these companies. So two of the companies we want to talk about today are Australis Oil and Gas, which is an oil producer, and Independence Group, which is a nickel miner, right? Now, yes, within resources, but two different beasts, oil, nickel. What did you see in these companies and why did you invest in them?
Well, Australis Oil and Gas, if we work through our process with the people are proven. They've done it before with a company called Aurora Oil and Gas.
Okay, so they have that experience.
So they have that experience, and they made money doing that, and they're putting it back in to this vehicle alongside shareholders in a reasonably big fashion. So the board of management of that company own over 10% of the company. And we just find that fast forwards a lot of conversations we might have with people about debt structures, what they pay themselves, but whether they should sell the company or not.
Yeah.
So that's one thing we like to look for. Australis boiling down to commodities. At the time, we really liked the outlook for oil because oil was quite simply trading too low. It was never going to incentivise future production growth that we have to have at 40 or 50 bucks a barrel. But what we wanted was something that would really perform if the oil price went to 70 or $80 a barrel, sort of where it's sitting today. And a lot of the stocks on the ASX we thought were pricing in $70 or $80 oil already.
Yeah.
Whereas the Australis asset, it made all the difference in the world between sort of $40 and $50 oil and $70, $75 oil in terms of economics.
Yeah, wow. So this was a company with proven people, and you bought it at a time when the oil price was depressed. So
Yeah.
I guess it had leverage in two ways: the oil price going up, but people who also knew what they were doing.
Yeah.
Okay, thanks, Dermot. So we talked about Australis. Let's talk about Independence Group. So it's a nickel miner. Why did you decide to invest in that company?
Great question. I guess the real question is why did we decide to invest in it when we did?
Yeah. Okay.
And there's a combination of reasons there. The first one being the capital. So we appreciate people who run Independence. They're good operators. They're proven operators. But they took on a large amount of debt to buy the Nova nickel asset. Now they're currently at the point where that debt is being equalised by the cash build-up. So they're turning net cash neutral on the balance sheet, which is quite an important event for us. And they've also fully developed that mine, which is quite unusual. Fully developed the decline, they've fully grade controlled the mines. The capex profile is very attractive going forward on that one, and we like the outlook for nickel in the electric vehicle world. It's going to be a slower burn in terms of supply squeeze versus lithium, for example, but it's going to take a lot longer to solve, and the nickel price isn't there yet to incentivise people to solve that problem longer term.
Okay, so there's quite some upside you see in nickel.
Yes, we think so.
Okay, that's fascinating, Dermot. So, and last question in terms of risk management, do you see points in time where you you talked about when you build your positions, do you see points in time when you think you'll exit?
Yeah, I mean, that's definitely happened. You either want to exit to another fund manager, typically for us, or to a corporate. Maybe to work through another example that we've had in recent history. 2 or 3 years ago, I said we really like the outlook for oil. Mm-hmm. We had a very large holding in Beach Petroleum, and we were in there predominantly for the oil exposure and the balance sheet, and they actually had a decent exposure to the oil price, unlike a lot of the listed stuff on the ASX. Now, ironically enough, the oil price did do very well, and that's definitely driven the Beach share price, but the real kicker came when they bought the Origin gas assets. They came with relatively fixed but stepped up price contracts, and that's been great for us. We subsequently sold Beach because we thought it had turned into a gas company, but was behaving in the stock market like an oil company, and we couldn't really justify the valuation, so we sold out of that position. And also we were cognizant of the overall portfolio exposure to oil, which was building up as other stocks performed as well.
Dermot, thank you so much for coming into NabTrade's offices and sharing your insights with our investors on investing in commodities. You mentioned people, balance sheet and cash flow, very important things to look out for, and I'm sure our investors will find this video very resourceful. Thanks so much. I hope you found this video informative. Now, please remember what we talked about today isn't investment advice. If you're thinking about looking at Westoz in an investment company or you're investing in any other securities, it's really important that you do your research and consider seeking financial advice. My name is Vishal Tekshilani, and I'll see you next time.